Hey, I'm Ryan, a CFP with RI Financial. Choosing between repaying debt and investing can sometimes seem like trying to solve a riddle. Making the right decision can have a significant impact on your financial future, and it's not as easy as choosing one or the other. So stick around to find out what option may be best for you. Let's understand our options. When you find yourself with some extra cash, you may often face the dilemma of, hey, should I invest? Should I repay debt? Should I do a little bit of both? Let's explore when each option makes the most sense and how we can optimize your financial strategy. When it comes to debt repayment, start by focusing on debts with high interest rates, like credit cards. These types of debts typically carry higher interest rates than any potential investment returns, making them priority targets for repayment. A tip here is to list out all of your debts, tackling the highest debt first. This is more commonly known as debt avalanche and will help minimize the total amount of interest you pay, as well as accelerate you to reaching debt freedom. Repaying debt also enhances your credit score, which is crucial when it comes to future loans, mortgages, or even potentially job prospects. You want to maintain a low amount of debt in relation to your income to improve your financial health, as well as increase any potential borrowing power. Here you want to monitor how much credit you are using or have used against how much credit is available to you. Keeping this ratio low will boost your credit score as well as open doors to better financial opportunities. When it comes to investing for your future, investing early allows your money to grow and compound over time, potentially yielding significant returns. For instance, retirement accounts like RSPs benefit from compounded growth over many years or potentially decades. Here you want to take advantage of, when applicable, employer match contributions to maximize retirement savings. It's basically free money and will help accelerate you towards your long-term financial goals. But like with anything investing, you always want to assess your risk tolerance when choosing your investments. Stocks will offer higher returns, but with that comes volatility, where on the flip side, bonds provide more stability but will offer a lower return. This is where you want to diversify your portfolio to mitigate risk. Allocate your assets across different sectors or different asset classes to provide some balance against any potential gains or losses you may incur. When it comes to striking a balance between these two options, always prioritize building an emergency fund alongside debt repayment and investing. This fund will cover any unexpected expenses, preventing any new debt accumulation during this financial emergency. It's recommended to aim for 3 to 6 months worth of expenses for this emergency fund and keep it as liquid and accessible as possible. So place it in something like a high interest savings account or perhaps a money market fund. You can also explore options like debt consolidation loans and balance transfers to help streamline the debt repayment process. The lower interest rate will help reduce the total interest you pay, as well as accelerate your ability to repay that said debt. There are some different methods that you can use to approach this, such as balance transfers for credit cards, where you transfer the balance of your high interest credit card to that of one with a much lower interest rate. You can look at debt consolidation loans, where you're ultimately consolidating all of your different debts into one convenient loan, which is meant to make it a little bit more simple and easier for you to stay on top of. And then where applicable and you have a home, you can also look into the home equity line of credit, where you're ultimately taking equity out of your home to apply for a loan with presumably a much lower interest rate. So let's discuss when you should repay debt, invest, or perhaps do both. Prioritize debt repayment when interest rates exceed any potential investment returns, especially with things like credit cards and high interest loans. You have to remember, credit cards can have interest rates ranging from 20 to 24%, and finding an investment that will generate that sort of return is very unlikely or uncommon, especially for an investor who finds themselves to be very conservative. Balance between debt repayment and investing when interest rates are fairly moderate. Allocate that extra cash to both goals to maintain some financial flexibility. Focus on investing when interest rates are low. Investments may yield higher returns when compared to the carrying cost of low interest debt, something like a student loan or a mortgage, but remember, investment returns are not guaranteed. Before putting any plan together, make sure you have a few boxes checked off your financial to-do list first. Things like pay the minimum on all your debts, have that emergency fund in place, and pay off your credit card debt. This will help ensure basic financial security, protect your credit score, and help you survive any unexpected curveballs life might throw your way. Where applicable, you can also try and maximize those employer matched contributions to those retirement plans to benefit from that free money. Making informed financial decisions is key to achieving long-term financial success. Whether you opt to tackle debt, build investments, or perhaps combine both strategies, tailor your approach to your financial goals and risk tolerance. If you found this video helpful, don't forget to like, subscribe, and share it with a friend. In the comments below, leave your experiences with debt repayment and investing. If you're seeking personalized help, reach out. Thanks for watching and happy planning.